April 2nd, 2025 will be a date that goes down in the history books. Yesterday marked the long-anticipated Liberation Day, the day on which the White House was set to provide some final answers on this next round of tariffs. And boy, did they provide some answers. Sweeping tariffs, a sharp market turn, and global leaders scrambling to decide how to respond. I wanted to take some time today to go through these tariffs, talk about how they're impacting financial markets, and talk a little bit about how this might change things for the next few years. Because this isn't just noise. This has the potential to bring a real shift in the geopolitical landscape, one that could impact prices, jobs, investment strategies, and the way the US does business with the rest of the world for years to come. If you somehow haven't heard the news, the Trump administration just rolled out a 10% tariff on all US imports, and that's just the beginning. Certain countries are seeing even bigger hits. China, 34%. The European Union and Japan, 20% and 24% respectively. Canada and Mexico, they're getting hit with their own 25% tariffs. We're talking about more than just a change in trade policy here. This is a trade reset. But before we get into it, please show your support for what we do here by hitting that like button and subscribing below. It really helps out the channel, and even better, it's totally free. To understand why all of this is such a big deal, let's step back for a second. For most of the last century, the US has pushed for more trade, not less. That meant lowering tariffs, opening borders for goods, and a ton of deals with countries all around the world. It was all based on this idea that if countries trade more, everyone ends up better off, which is a pretty central theme in economics. Now, over the past couple decades, globalization has picked up speed, and some groups feel that they haven't benefited equally from that. US factories have closed, some jobs have moved overseas and never come back, trade deficits have widened. Basically, a lot of people have started to feel like the system isn't really working for them. Fast forward to 2025, and the Trump administration says enough is enough. These new tariffs, they're trying to reverse decades of trade policy in one swing. The goal is to protect American industry and fix the trade imbalance, but the way it's being done raises quite a few red flags. So let's break this down as simply as possible. As we've talked about numerous times now, tariffs are basically taxes on things that we buy from other countries. And when you add taxes to a price, that thing gets more expensive. It's pretty easy to understand, but here's where it gets a little messy. Say a US company imports car parts from Japan. Suddenly, there's a 24% tax on those parts. That extra cost, it's not coming out of the foreign company's pocket. It's getting passed to the US buyer. That buyer then passes it along to the next person in the chain, all the way down until it hits the consumer. So whether you're buying a car, a phone, or even groceries that rely on imported packaging or equipment, you're more than likely going to pay more. But it's not even just about price tags. US companies that use imported materials now have to spend more to make the same product. That means lower profits, fewer hires, and probably even some layoffs. It adds friction into a system that runs best when everything moves smoothly. And if other countries retaliate, US exports like agriculture or manufacturing, those are going to get hit too. So it's not just about imports, it's also about what we sell abroad. It hasn't taken long for the markets to react. The S&P 500, Dow Jones, and NASDAQ have taken a big hit today. But what caught a lot of people off guard? The US dollar is losing value. That goes against what most people expected. Normally, tariffs mean fewer imports, which narrows the trade deficit and boosts the dollar. But investors aren't just thinking about the trade math. They're looking at the bigger picture. They're starting to question whether the US is still the steady, predictable player it has always been. And the fact that the dollar fell instead of rising really says something. It suggests that investors think these tariffs could hurt our long-term growth. They're not seeing a strong economy getting stronger, they're seeing risk. One of the big talking points behind these tariffs is the trade deficit. The Trump administration is basically saying, if we buy more from a country than they buy from us, we're losing. But here's the truth. Trade deficits aren't a scoreboard. They don't automatically mean one country is winning and the other is losing. A trade deficit just means we're importing more than we export. But that can happen for a bunch of reasons, like if we save less and spend more as a country, which is something that we talked about in yesterday's video. It also happens because foreign countries love putting their money into US markets. They buy our bonds, our stocks, and our real estate, and that capital inflow makes the dollar strong, which makes our exports more expensive. So when the administration ties tariffs directly to a trade deficit, it's kind of missing the point. It sounds logical on the surface, but underneath, it's a lot more complicated than that. And treating a complex problem with a one-size-fits-all solution usually backfires. There's another layer here that I don't think is getting enough attention. When the US uses aggressive tariffs like this, especially against allies, It encourages other countries to break off and make their own plans. Rightfully so. They start trading with each other more, they look for ways to use other currencies instead of the dollar, they build systems that don't rely on the US. It's kind of a slow process, but it adds up over time. And that's a problem, because the global demand for dollars gives the US some pretty major advantages. It lowers our borrowing costs, it gives us leverage, and if that demand starts to fade, we could be looking at weaker currency, higher inflation, and less influence globally. It's like pulling a thread that holds the whole system together. It might seem pretty small and insignificant now, but over time, it's going to start to unravel. Let me be clear here. There is a case to be made for protecting key American industries. There are sectors where we want to be self-reliant, like semiconductors, medical supplies. Nobody's arguing against that. But this approach, blanket tariffs with barely any warning, any time to prepare, that's not strategy. It feels a lot like improvisation. If you're a company trying to decide where to build your next factory, the last thing you want is policy whiplash. You want consistency. You want to know the rules, otherwise you're just going to freeze. You hold back on hiring, you delay investing, and the economy slows down as a result. If we want smart industrial policy, it has to be deliberate, thought out, phased in. Right now, this feels more like trying to fix a leak with a sledgehammer. Guys, this moment matters. The Trump administration's new tariffs aren't just another headline. They signal a real shift in how the US wants to engage with the rest of the world. And while the goal might be to strengthen the economy, the strategy might end up doing the opposite. Higher prices, market instability, global tension, these are all very real possibilities. It's too early to say how all of this is going to play out for sure, but it's not too early to pay attention, because these policies are going to touch almost every part of the economy, from what we buy to what we build, and how the rest of the world sees us. What do you think about all this? Is this a smart move by the Trump administration or a risky gamble? I'd really love to hear your thoughts in the comments, and if this helped you kind of understand the bigger picture of what's going on in the world right now, please consider subscribing and liking the video. It means the world to me. And until next time, have a good one.